What are the downside risks for the Federal Reserve of doing even more?
Well, the way I view what we've done so far is, remember, we saw that the financial markets were not functioning well. So we took very strong actions to make sure that the financial markets continued to function so that credit could flow to households and businesses. Without a functioning financial system, we'd have a financial stability crisis on top of a pandemic crisis. So no one would have wanted that. So our actions so far have been, I think, impactful. I think you've seen the financial markets working better. I think liquidity is flowing. And I think those have been important programs that we set up, these emergency facilities. Some of them are still to come in terms of opening for business. The terms are being negotiated with Treasury and to make sure that those programs work well. So that's kind of the state of play there. I think as the economy and more places begin to open up, we'll have a better sense of what the recovery is looking like. And we may have to, and I expect that we'll have to support the recovery going forward. But we're really at the very beginning stages of that because there's still parts of the country that are shut down. So it really depends on what you mean by doing more. I do think there's going to be a second phase of monetary policy, but that'll be more of the supporting the recovery, supporting activity, making sure that we can have a recovery that takes hold and develops.
Well, President Mester, let's talk about that, because quite clearly a couple of months ago, it's night and day compared to where we are now. And I think it would be hard pushed to suggest that it's about market functioning anymore. You've talked about that next phase. If the previous phase, the objective was market functioning, what does the next phase look like? And how are the tools different? How is the response to the Federal Reserve different?
Right. So the way I view it is, just think about the second quarter. The second quarter numbers, when they come out, are going to be very, very negative numbers. I mean, we know that. We know that that was the height of the shutdown when there was no activity. In the third quarter and fourth quarter, we're going to see activity begin to emerge. I think some of the quarterly growth rates are going to overstate what it looks like really out in the field, because we're going to see from a base of very little activity, some pickup in activity, and they're going to look like big growth rates. But we're still going to be below where we were at the start of the year in terms of both employment and output. So I think we have to take this, looking at how this is emerging. I think there's a lot of concern about second waves of the virus. So what makes this difficult is that we have both economics going on and also a health crisis going on. And so that's very different than other economic shocks that we've had in the past. And so I think a lot of how the recovery goes is going to be dependent on COVID testing, the 3 C's: COVID testing, contract mapping, and making sure that the capacity of the healthcare system can handle an increase in cases that every epidemiologist is telling us that we should expect over the second half of the year. That means that the recovery could be slow. When you have so many people out of work, it's hard to imagine that we'd see a quick V-shaped recovery. I think it's going to be slow. I think businesses are going to be thoughtful about reopening. I think people are going to be thoughtful about spending. And so what that means is that monetary policy has a role to play as we support the economy, getting back to our dual mandate goals of full employment and price stability. And so that's more traditional monetary policy, and the tools that we have are our interest rate tool, which already is at 0, forward guidance, which we've used before, and also asset purchases, but asset purchases not to improve market functioning, but really to support the economy as it moves forward towards full employment and price stability.